UiPath stock is down considerably in 2022. So let's take a look at their second quarter transcript and try and determine what's going on with UiPath stock. Co-Chief Executive Officer Rob Enslin starts off by saying their ARR crossed the 1 billion mark. ARR stands for annual recurring revenue, crossed the 1 billion mark, totaling 1.043 billion, which was an increase of 44% year over year, driven by net new ARR of 66 million. So slower acceleration, but still solid growth year over year. We now serve more than 10,500 customers, and automation continues to be a central part of digital transformation for companies of all sizes and across all industries. And I would add to this and say right now is an environment where automation is going to be of even more importance as inflation is increasing costs for companies. They're going to look to offset those costs through automation. But at the same time, right now is also a scenario where businesses are cautious in the investments they're making because of the uncertain macroeconomic environment. So, you know, there's a tailwind at its back and also a headwind at its back, both simultaneously hitting UiPath stock right now. Management highlights that they have a first mover and technological advantage, and as the automation leader, we continue to expand the value we can deliver for our customers. Our go forward priority will be to balance investing for long term growth while managing the business to consistently expand non GAAP operating margin and deliver sustainable positive adjusted free cash flow in year 2024 and beyond. Of course, if you've been following the stock market in 2022, it's been a year of investors shying away from unprofitable growth stocks and looking for companies that deliver profits on the bottom line, are cash flow positive, and so it's not popular for companies to invest at growth at all costs. And this is UiPath management acknowledging that trend and saying, look, we realize what's going on in the market. We realize the cost of capital is rising. We're going to focus on prudently managing the business for growth, meanwhile aiming to achieve these profit goals over the next couple of years. This was interesting. I saw in their earnings call was a an outline of their four strategic objectives. First, investing in the platform to increase the competitive moat, or in other words, their competitive advantage. Second, to increase velocity and productivity, which is a bit unclear as to what they mean by that. But a little bit down the line, we see that means to simplify their sales motion to lower cost, building strategic partnerships that evaluate our brand and serve as distribution channels, and coalescing around partners that can really move the needle. So, focusing their efforts to a more core task base and not spreading themselves too thin and going after those opportunities that could provide meaningful results instead of just going after every single customer that they can go after. They're focusing their efforts on going after customers that can really move the needle. So more customers that can provide a more magnitude in terms of revenue base. Third, they're bringing together a diverse team around driving UiPath to the next level, and they made some announcements of some solid hires. And for a growth company, hiring talent is an important task, sometimes challenging to do. So if you can secure big name, effective, proven management leaders, that can be a good sign for your stock in the future. And finally, and equally critical, they are committed to sustained profitable growth by leveraging their scale and exercising disciplined resource allocation. This is UiPath stock management telling investors, hey, look, we realize cost of capital is increasing and we're going to take steps to reduce our ambition, take it slower, focus on profitable growth and not just go all out in trying to attract new customers, attract more revenue, attract more talent. We're going to kind of take a more measured approach to these significant strategic goals. And investors liked that idea. And several unprofitable growth stocks have begun shifting their focus in this regard to this more profitable growth ambition because investors have just shied away from unprofitable growth stocks. They don't like to see their stock prices falling as much as they have, and UiPath's stock price is down meaningfully in 2022. Management is trying to do their best to reverse those losses. And it continues to Daniel Dines, the co-founder and co-chief executive officer, who starts off by saying, we continue to hear from our customers that the breadth of capabilities in UiPath's automation platform is why we win. UiPath is the only company that offers a complete solution. And that can be beneficial if a company is looking to automate and looking for who are they going to choose to help them automate their processes. If they can go to UiPath for a complete solution and they only need to go to one vendor to solve their automating needs, that can help because a company's management doesn't want to be spending all of this time going to different vendors securing the needs of the business going forward. If they can just have a one-stop shop, that can save management time in search costs. Moving on to Ashim Gupta, the Chief Financial Officer. An important metric, of course, for software business is dollar-based retention, and this measures how much of your revenue are you keeping on a recurring basis, right? If you had $100 in recurring revenue, how much of that is moving forward? So are you keeping all of that and expanding on it, or are you starting with 100 and then moving down to $80, which is not as good? So for UiPath, they reported good news, right? Dollar-based retention was 132%. So starting out at $100, moving forward to $132, going forward, expanding their recurring revenue. That's good news for UiPath stock investors. Revenue in the quarter grew 24% to $242 million. Their remaining performance obligations increased 36% to $709 million. Remaining performance obligations stands for contracts that the company has signed but has not delivered the performance yet. So you could think of this like when you subscribe to a magazine for an entire year. Even though you might pay for the entire year up front, the magazine company does not recognize the revenue until it recognizes the revenue, I should say, on a monthly basis as it delivers to you the monthly magazine, right? So when you subscribe to a magazine for the entire year, they recognize 1/12 of the revenue in the first month, 1/12 in the second month, 1/12 in the third month, and so on until their performance obligation is completed. And the performance obligation for magazine companies is to deliver the magazine to you. And for UiPath, it's to deliver their software services to their clients. The CFO goes on to report a GAAP, which stands for Generally Accepted Accounting Principles, operating loss of $120 million, including $88 million in stock-based compensation. So massive losses on the bottom on profitability of $120 million. Their revenue was just north of $200 million, an operating loss of $120 million. Meaningful loss and not a good sign for UiPath stock investors. But thankfully, they do have $1.7 billion in cash and cash equivalents on hand, so liquidity is not a concern. Even though they're losing money on the bottom line, they still have so much cash that they can sustain themselves for several quarters, if not several years. Interestingly, more than half of their business is based outside the US, and they price in local currency, including the euro and the yen. And because the dollar has appreciated against foreign currencies, this was a headwind for both ARR and revenue that has significantly increased as they move through the year. So this was a headwind for UiPath in this quarter, and perhaps it's going to be for the next few quarters as well. For the third quarter, their forecast is they expect ARR in the range of 1.09 billion to 1.093 billion, including an incremental foreign exchange headwind, okay? And they expect revenue in the range of 243 million to 245 million. So sequentially, that's going to be growth over the current quarter. And they expect non-GAAP operating loss to be in the range of negative 30 to negative 25 million, reflecting timing of investments. And they expect third quarter share count to be 550 million shares outstanding. And for the full year, they expect ARR in the range of 1.15 billion to 1.158 billion. So good news is that they're expecting continued increases in annual recurring revenue, even though that growth rate is slowing down. But that is to be expected because the company is not investing in growth as heavily. They're looking at more prudently growing the business, looking at the lowest hanging fruit and not going after every incremental sales target, just trying to manage the business, grow the business, but not really step over itself in doing so. Just taking a measured approach. And I would say that's a good sign for UiPath stock investors because the cost of capital is rising, because the macroeconomic environment is so uncertain, because the risk of recession is so high. You don't want the company to be aggressively investing in growth right now. A more cautious approach is more called for in the current times, in my opinion. All right, so that's all I've got for UiPath stock earnings call deep dive. Please join me next time for another installment of a similar video. And if you liked what you saw here, please click that like button. It helps me produce videos just like this one and keep this exciting content flowing freely. All right, so thanks for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 354% as of September 21, 2022, and measured against the S&P 500 returns of 112% as of September 21, 2022.